Are you the proud owner of rental properties? Beyond the allure of steady rental income and the promise of property value appreciation, the realm of real estate investments unveils a treasure trove of deductions that can work wonders in trimming down your tax liability. Now, let's delve into the heart of the matter. What's your identity in the real estate investment landscape? Do you classify as a hands-off investor, content to let your properties work their magic, or do you wear the hat of a full-fledged real estate professional? This classification is more than just a label, it's the key that unlocks the way your gains and losses are handled in the eyes of the taxman. Tax treatment of income and losses. In the realm of investments, real estate is typically viewed as a hands-off endeavor. Nevertheless, the degree of your active involvement holds the key to how the taxman perceives and manages the income and losses stemming from your property. Now, let's unravel this intricate web of taxation a bit further. Your role as a property owner, whether hands-on or hands-off, plays a pivotal role in how the tax code treats the financial dynamics of your real estate venture. As we venture deeper into the world of real estate and taxation, don't forget to subscribe to our channel. By doing so, you'll stay informed about more insightful videos just like this one, helping you navigate the complexities of real estate investments with confidence. Real estate experts. In the eyes of the Internal Revenue Service, IRS, a real estate professional is defined as an individual who dedicates more than half of their working hours to the rental business. This comprehensive commitment may encompass diverse aspects, from property development, construction, and acquisition, to meticulous property management. To earn the esteemed title of a professional, you must also invest a minimum of 750 hours per year in the active management of your real estate rental portfolio. The activities of real estate professionals stand apart from passive endeavors. Rather than being labeled as passive income, your real estate income is deemed active, thereby making it eligible for the offsetting of other forms of income, such as wages, salaries, interest, and dividends. A notable advantage of this classification is the avoidance of the 3.8% net investment tax, should your rental properties yield income. Substantial engagement. Should you find yourself actively involved in your real estate profession, your tax treatment will reflect this substantial engagement. Any incurred losses can be effectively used to offset various income streams, and you'll remain exempt from the net investment tax. As per the IRS guidelines, your material participation in an activity can be confirmed if you meet any of the following criteria. You dedicate more than 500 hours to the activity throughout the year. You shoulder the lion's share of responsibilities within the activity. With at least 100 hours invested in the activity during the year, you match or surpass the contributions of others. If the activity qualifies as a significant participation activity, SPA, and you dedicate at least 500 hours to SPAs, you've maintained material participation in the activity for any 5 of the previous 10 years, consecutively or otherwise. In the case of a personal service activity, you've materially participated in the 3 preceding tax years. Based on the overall circumstances, your participation in the activity is considered regular, continuous, and substantial. Active involvement. Active participation represents a less stringent level of engagement compared to material participation. The IRS acknowledges your active participation when you genuinely contribute to management decisions in a significant and bona fide manner. Active participation encompasses decisions such as tenant approval, rental terms determination, and expenditure authorization. For those who actively participate in these management decisions and hold at least a 10% interest in the investment, there's a prospect of deducting a portion of passive losses. This level of involvement allows for a unique passive loss rule. In essence, you can deduct up to $25,000 of passive losses if your modified adjusted gross income, MAGI, doesn't exceed $100,000. The deduction gradually phases out between MAGIs of $100,000 and $150,000. Once your MAGI surpasses $150,000, the ability to deduct passive losses ceases. Any losses exceeding $25,000 can be carried forward to the subsequent tax year. Passive endeavors. On the flip side, if your involvement with your rental property remains more of a sideline investment, and you do not materially participate in it, it falls under the umbrella of passive activity. In such scenarios, any losses resulting from passive activities can solely be utilized to offset income generated from other passive activities. In essence, you are unable to employ losses from your rental property to offset taxable income from other sources. Instead, these losses are carried forward until you either generate passive income or decide to sell the investment. Rental property income sources. When you're a landlord, reporting rental income is a must, but it's not just about those monthly rent checks. Let's explore the various components. Rental payments. The money you receive from your tenants as rent is typically considered taxable income in the year it lands in your hands, irrespective of when it was due or earned. This rule extends to any advance payments you might receive. For instance, if you lease out a property for $1,000 per month and require tenants to pay the first and last month's rent when signing the lease, you need to report the full $2,000 as income. Even if $1,000 of that amount pertains to a future period, the IRS requires you to acknowledge it now. Tenant-covered expenses. Any expenses that your tenants cover become part of your rental income if these expenses aren't their obligation. For instance, if your tenant takes care of the water bill and deducts it from their regular rent payment, you are responsible for including that amount in your rental income. Depending on the nature of the expense, you may also claim it as a rental expense to balance things out. Bartered services. When your tenant offers services instead of rent, you must account for the fair market value of these services as part of your income. For instance, if your tenant paints your rental property in exchange for 1 month's rent, valued at $1,000, you must report this $1,000 as income, even if no cash changes hands. However, you can offset this by claiming a $1,000 deduction as an expense. Security deposits. Generally, security deposits aren't subject to taxation when you receive them, as long as they are intended to be returned to the tenant at the end of the lease. However, what if your tenant breaches the lease terms? Let's say you collect a $500 security deposit, and your tenant departs, leaving holes in the walls that require $500 to repair. In this case, you're obligated to include the $500 as income for that year, but you can simultaneously deduct the $500 as an expense for the necessary repairs. Rental property tax deductions. As a landlord, the potential for tax deductions related to the acquisition, operation, and upkeep of your rental property can be a significant boon. Let's explore the most prevalent deductions available to you. 1. Mortgage interest deduction. Costs incurred to secure a mortgage, such as commissions and appraisal fees, are not immediately deductible. Instead, they contribute to the basis of your property. However, you can deduct the interest on secured mortgage debt up to $750,000, $1 million if the mortgage predates December 16, 2017, for your primary or secondary home. For investment properties, mortgage interest is deductible as a business expense. Your mortgage company will furnish you with an IRS Form 1098 each year, detailing your yearly interest payments. If a portion of your payment goes into an escrow account for taxes and insurance, your mortgage company should also provide that information. 2. Rental property depreciation. Depreciation is a pivotal tax deduction. Rather than claiming one substantial deduction upon property purchase or improvements, depreciation allows you to spread the costs over the property's useful life. To be eligible for depreciation, the property must meet specific criteria. You must own it, use it for business or income-generating purposes, must have a determinable useful life, be expected to last more than 1 year, and not have been placed in service and disposed of in the same year. Residential rental property placed in service after 1986 follows the Modified Accelerated Cost Recovery System, MACRS, and spreads depreciation over 27.5 years. 3. Repairs and improvements. It's essential to differentiate between repairs and improvements, as they have varying tax implications. Repairs maintain the property's condition and are deductible in the year you pay for them. Examples include painting, plumbing fixes, and electrical repairs. Improvements, on the other hand, add value to the property and cannot be deducted when paid. Instead, the cost is recovered through depreciation over the property's useful life. Examples of improvements encompass a new roof, a patio addition, or a garage construction. Making repairs promptly is advisable from a tax perspective, rather than waiting for issues to compound into renovations. 4. Property taxes. Rental property owners incur ongoing property taxes. While homeowners are subject to a $10,000 limit for property taxes, this limit doesn't apply to business activities. Depending on your involvement level in the property, you may fully deduct property taxes as a business expense. 5. Travel expenses. Money spent on travel for rent collection or property maintenance is deductible. However, if the trip is primarily for improvements, the expense is part of the improvement cost. You have 2 methods for deducting travel expenses: actual expenses or the standard mileage rate. Consult IRS Publication 463 for the latest IRS requirements and mileage rates. 6. Other common expenses. Beyond the aforementioned deductions, several other expenses can be claimed, including advertising, payments to employees and independent contractors, home office expenses, insurance premiums, lawn care, losses from casualties or thefts, professional services, e.g., accountants, property managers, utilities, and the cost of personal property, e.g., appliances and furniture, used for rental purposes. These deductions can significantly alleviate your tax burden and enhance your financial gains as a rental property owner. Be sure to keep thorough records and consult a tax professional to ensure you maximize your benefits. What is not deductible? IRS regulations can vary depending on specific circumstances, but there are common expenses that are typically not eligible for deductions. Let's delve into these general categories. 1. Personal expenses. Generally, expenses of a purely personal nature that have no direct connection to the rental property are not deductible. This includes personal expenditures on items like food, clothing, or personal travel. Consider a scenario where you temporarily stay at a rental property you own to conduct repairs. The personal expenses associated with your stay, such as meals and personal travel, are not deductible. 2. Repairs versus upgrades. Distinctions exist between repairs and upgrades when it comes to deductions. While expenses related to upgrades that increase the property's value or extend its useful life are typically deductible, they may need to be capitalized and depreciated over time rather than fully deducted in the current year. Repairs, on the other hand, do not lengthen the asset's useful life or enhance the property's overall utility. Therefore, both repair and upgrade expenses may be deductible, but certain costs may require spreading out over time. 3. Expenses during vacancy. Deducting expenses linked to a rental property during periods of vacancy or when it's not generating rental income can be challenging. This may include costs like mortgage interest or advertising expenses. It's essential to be aware that exceptions in specific regulations may apply depending on your jurisdiction. Additionally, if you operate on a cash basis, uncollected rents cannot be deducted until they are captured or accrued as income. 4. Cost of travel. Typically, travel expenses incurred between your home and the rental property are classified as personal expenses and are not tax deductible. However, there might be deductions available for travel related to property maintenance or management. 5. Fines and penalties. Much like other tax deductions, you generally cannot deduct fines and penalties. Expenses associated with fines or penalties related to violations of laws, regulations, or homeowner association rules are usually not deductible for a rental property. In many instances, adherence to existing regulations could have prevented these fines and penalties, making them ineligible for deduction. Understanding these limitations on deductions is crucial for managing your tax obligations as a rental property owner and ensuring compliance with IRS regulations. Condominiums and cooperatives. When it comes to rental properties like condominiums and cooperatives, there are unique rules to consider. Condominiums. If your rental property is a condominium, you likely contribute dues or assessments to maintain shared spaces like lobbies, elevators, and recreational areas. These expenses, such as depreciation, repairs, interest, and taxes related to these communal areas, are deductible when you rent out your condominium. However, similar to a single-family rental property, you cannot deduct funds allocated to capital improvements, such as an assessment for a new cabana at the clubhouse. Instead, you must depreciate your portion of the improvement cost over time. Cooperatives. Expenses linked to a cooperative apartment that you rent out can be deducted, including maintenance fees paid to the Cooperative Housing Corporation. Capital improvements, on the other hand, are treated differently. You cannot deduct the costs of improvements, nor can you depreciate them. Instead, you should incorporate the improvement costs into your basis in the corporation's stock. This will, in turn, reduce your capital gain when you decide to sell. Recordkeeping. Within the IRS's Schedule E, you'll discover designated sections for various expense categories. This flexibility provides you with the latitude to claim deductions for a range of items. However, it's crucial to be ready to substantiate your claims and distinguish expenses related to repairs and maintenance from those linked to capital improvements. It's worth noting that the funds you invest in improvements could have a positive impact on your tax liability when the time comes to sell your property. To support your deductions effectively, plan to maintain a comprehensive collection of supporting documentation, including appointment books, diaries, calendars, and detailed logs. These records will serve as tangible evidence of your active involvement and the time dedicated to your properties each year, reinforcing the legitimacy of your claims. Frequent questions. Where should I record rental income? Your rental property's income, expenses, and depreciation are to be reported on Schedule E of your 1040 or 1040 SR, US. Tax return for seniors. In cases where you possess more than 3 rental properties, you'll need multiple copies of Schedule E. What deductions are applicable to rental property? As a landlord, you have the opportunity to claim deductions that can offset your rental income and, in turn, reduce your tax liability. These deductions encompass qualified rental expenses like mortgage interest, property taxes, utilities, and interest, as well as operational costs and repair expenditures. Furthermore, you can depreciate the expenses associated with acquiring and enhancing your property over its useful life, typically spanning 27.5 years. Additionally, there's the potential for deducting up to 20% of your qualified business income, QBI. However, for eligibility for the QBI deduction, your rental real estate must meet the requirements set out in Section 162 of the Internal Revenue Code and other stipulations. What does a 1031 exchange entail? Upon the eventual sale of your rental property, you could be confronted with capital gains and depreciation recapture taxes. To mitigate these tax obligations, many real estate investors turn to a 1031 exchange, a mechanism that enables the exchange of one investment property for another. According to the IRS, the properties involved in the exchange must be like-kind, signifying they share the same nature or character, regardless of variations in grade or quality. Generally, properties are considered like-kind whether they are improved or unimproved. Is rental income treated as regular income? It may be. If you rent out a property for more than 14 days in a given year, you are obligated to report the rental income on your tax return. Subsequently, the net income is subject to taxation as regular income. Conversely, properties rented out for 14 days or fewer do not necessitate income reporting or tax payment. Effectively managing a rental property's financial aspects hinges on a comprehensive understanding of tax regulations. Given the array of deductions available, it is paramount to identify those you qualify for to optimize your financial outcome. Moreover, comprehending the tax implications of rental income and property sales is essential. For expert guidance and assistance on deductions, tax considerations, and overall planning, it is advisable to consult with a qualified tax professional. As we wrap up this insightful exploration of real estate tax deductions, we hope you've gained valuable knowledge about optimizing your rental property investments. Understanding the intricacies of tax deductions can significantly impact your financial success in the real estate market. If you're eager to delve deeper into the world of real estate and want to avoid common pitfalls, we've got you covered. Check out the video displayed on your screen, where we discuss crucial real estate mistakes to avoid. Thank you for joining us, and we look forward to guiding you through more essential real estate topics in the future.